Wall Street is lending trillions of dollars to AI companies and then immediately buying insurance against those same loans going bad. So let that sink in for just a second. Oracle's debt protection costs just hit 2008 financial crisis levels. Yet, yes, that 2008. Trading of Oracle credit default swaps jumps from $350 million to $8 billion in just 9 weeks. So when your own lenders make you a loan and then immediately hedge against you not paying it back, they're nervous about something. So the question we need to answer today is, are we in an AI bubble, or is this real progress? Because after a long time in software development, I've watched the dot-com bubble, the crypto crash, and a lot of others, the NFT implosion, and a lot of other weird markets. Now, there's some interesting warning signs here, and we're going to dig into some of these today. I'm not necessarily saying 100%, but let's dive in and take a look at some of the warning signs and see what this crazy market looks like. Welcome to Startup Hack. I'm Spencer, and here at Startup Hack, we love to build custom software solutions for companies. With a decade of executive leadership as a fractional CTO and 25 years in software development, I've mastered transforming tech teams and products. All right, look, I know what you're thinking. Spencer, AI is different. It's actually really useful. Now, you're not wrong, and that's where things look really different, right? Because here's the legendary investor, Howard Marks, just laid out in his latest memo. He said the technology can be revolutionary, and there can still be a bubble around it at the same time. The railroads transformed America and destroyed investor wealth. The internet changed everything, and the bubble still popped. Today, we're going to break down some of the critical factors that will help you to understand whether you're watching history repeat itself. But by the way, as always, leave a comment down below, because that's the best compliment you can give me, is to leave a comment. It's the best thing you can do to help the algorithm and help me out with this channel here. So let's dive into some of these reports here, and then we'll kind of go into some of my analysis on them. So, a better way to think about the bubble, right? People often think that tech bubbles in apocalyptic terms, but it doesn't have to be as serious as that. In economic terms, a bubble is a bet that turned out to be too big, leaving you with more supply than demand. The upshot is not all or nothing, and even good bets can turn sour if you aren't careful about how you make them. What makes the question of the AI bubble so tricky to answer is mismatched timelines between the breakneck pace of AI software development and the slow crawl of constructing and powering a data center. Because these data centers take years to build, a lot will inevitably change between now and when they're online. The supply chain that powers AI services is so complex and fluid that it's hard to have any clarity on how much supply we'll need in a few years from now. So, and I agree with that. Reuters was reporting that Oracle Inc. data center campus in New Mexico has drawn as much as $18 billion in credit. This is, and those are crazy numbers, right? A McKinsey survey released last week looked at how top firms employing AI tools. The results were mixed. Almost all the businesses contacted are using AI in some way, yet few are using it in any real scale. And that's part of what we're seeing here, is it's like everybody's using it, but it's not really transforming businesses yet. Even if AI demand is endless, these projects could run into more straightforward infrastructure problems. Satya Nadella surprised a podcast listener by saying he was more concerned that running out of data center space than running out of chips. As he put it, it's not a supply issue of chips, it's the fact that I don't have warm shells to plug into. With NVIDIA and OpenAI have been moving forward as fast as they possibly can, the electrical grid and built environment are still moving at the same pace they always have. So we know we're going to run into a power problem, right? This is an interesting one. Anthropic is on track to turn a profit faster than OpenAI. This is one of the interesting things. So we see OpenAI was part of this bubble that launched first, and now Anthropic. This is totally the hare versus the tortoise, right? And the tortoise being Anthropic, they're coming up quickly behind, whereas OpenAI was the one to sprint out to the front. So financial documents from the company show different approaches they're taking on the AI boom. Another one, if I can get the menu to go away. Let's see here. OpenAI's less flashy rival might have a better business model, right? Anthropic, backed by Amazon and Google, is focusing on corporate customers rather than mass market. So whereas OpenAI is bragging about all of their 800 million active users, Anthropic's like, hey, we've got the enterprise, which is the ones that actually pay. Let's look at this one here. So Anthropic is catching up with OpenAI. Right? All about Amazon. Amazon has big plans for warehouse automation. Look at its robot. It's a little surprised that Amazon investments and knowledge from its earlier works are paying off. The New York Times got its hands on a trove of internal Amazon documents, according to which the company expects robotic automation to let it avoid hiring more than 160,000 people in the United States would otherwise be needed by 2027. Amazon execs reportedly also told their board that its investments in robotics would allow the company to continue to avoid adding to U.S. workforce in the coming years. None of this is shocking, right? Now, the only thing I will say is AI really hasn't had a ton to do with this. Amazon's been working on automation for 2 decades. They've been working on automation for a long time. But Anthropic is catching up to OpenAI. Anthropic co-founder Jack Clark gave an interesting talk recently about how he went from being a journalist to working in AI. First, he was impressed by the pace of the technology, and later he hopped under the trenches to start his own company. He says, I think a CEO as a part-time blogger concept we're seeing in the AI field should be encouraged and expanded to other parts of the technological world. So he said, I'm sure you've caught up with the ensuing drama and arguments both against and in favor of Anthropic. Reid Hoffman, another member of the PayPal Mafia, chimed in a bit later, arguing that Anthropic is one of the good guys and that it's important to back the good guys, especially in AI. You're definitely not going to hear me categorizing OpenAI as one of the good guys, but I'm not sure that we can go as far as to say Anthropic is one of the good guys. OpenAI's growth is insanely good, yet it's a lot less than Anthropic's growth this year, 136 versus 600. Anthropic may just catch OpenAI. That's kind of the news here. The net revenue race between Anthropic and OpenAI is getting heated. We got some growth charts here, right? Anthropic could catch them, right? We see Anthropic has started later, but its growth curve is actually tighter and higher, especially on revenue, than OpenAI's is. All of my favorite pop-ups. So is AI adoption slowing down? A few weeks ago, my pal and favorite CFO pitched me on starting a podcast together. I immediately said yes, but another condition. It couldn't be another boring interview show. I'll periodically recap the stories, new data on AI adoption. So he goes through and talks about what they were covering. Here we go. This is the part I was getting to. So shares of U.S. business with paid subscription on the AI model. So we have overall, you can see it's starting to tip off. You can see OpenAI is starting to tip off. Anthropic has been, definitely, less parabolic here, but they're starting to tip off, and we see everybody else is starting to tip off. When you toggle the chart by sector, 73% of U.S. technology businesses have paid subscriptions to AI models, platforms, and tools. Tech has far and away the highest AI adoption, though it's plateauing. Finance is a major AI adopter too, with 58% having paid subscriptions. It isn't necessarily breaking through to the broader economy in verticals like retail, construction, and accommodation and food services. There's some positive news in the RAMP report. AI products are getting much stickier. RAMP data shows that the annual retention of AI products was about 60% in 2023. It's on track to exceed 80% in 2025. Let's keep going through some of these here. So before we dive into a subject at hand, having read a great deal about a preparation, I want to start with a point of clarification. Everyone asks, is there a bubble in AI? I think there's ambiguity even in the question. I've concluded there's two different but interrelated bubble possibilities to think about. One is the behavior of companies within the industry. The other is how investors are behaving with regard to the industry. He's going on and saying bubbles usually coalesce around new financial development or technological process. Newness plays a big part in this because there's no history to restrain the imagination. The future can appear limitless for a new thing, and futures are perceived to be limitless, can justify valuations that go well beyond past norms, leading to asset prices that aren't justified on basis of predictable earning power. That's a bubble. The key thing to note here is that the new understandably inspired great enthusiasm, but bubbles are what happen when the enthusiasm reaches irrational proportions. We've heard the term irrational proportions from a lot of the big CEOs. Struggling with whether to apply the bubble label can bog you down and interfere with proper judgment. We can accomplish a great deal by merely assessing what's going on around us and drawing inference in regard to proper behavior. So anyways, he's going on to say that basically, that there's a bubble, but what do we do about it, right? And so that's kind of the point. Now, a lot of times these articles, I'll go to the very end because you'll see a really good, synopsis here at the end, right? For my final citation, look at Sam Altman of OpenAI. His comments seem to capture the essence of what's going on. When bubbles happen, smart people get overexcited about a kernel of truth, Mr. Altman told reporters this year. Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes. Is AI the most important thing to happen in a very long time? My opinion is also yes. Now, of course, Sam Altman's going to say that. He's trying to plug his company, right? Now, what we are seeing is this over and over again. We see OpenAI as a leader. We see a little teeny peak where Meta was. We see a peak where XAI was. And now we see where Google is, right? And even since this chart, we've now seen where OpenAI in some categories has taken back that lead to some. We'll see that in benchmarks versus reality. So as an AI expert who totally doesn't think LLMs are the path to AGI, but use LLMs very avidly to get things done, here's my take utility of top LLMs. If you don't know what you're doing in a certain domain, you can get interesting and valuable results, but they will be mixed up with garbage and you'll have trouble identifying the garbage. Therein lies the problem. In some cases, automated methods can be used to test filter results, but this remains mostly dodgy in real world. If you do know what you're doing in some domain, but you're not willing to creative adapt your work style to the LLMs, then you won't get as much out of them except time savings on some roadish tasks. If you do know what you're doing in some domains and are willing to open mind and creative work, you can amplify your abilities and output dramatically, though still with some trade-offs. In many respects, LLMs assist products are still not as good as expert human-crafted products, though there are some better in variations. So in my opinion, what he's saying here is we're going to see that humans or experts in a field become the premium, whereas the rote stuff that can be done by LLMs, we're going to see continue to be done by them. Now, Wall Street is lending trillions to AI companies while simultaneously buying insurance against those same loans going bad. This is what I was reading at the beginning, right? Global bond issuance hit $6.4 trillion in 2025. Hyperscalers are expected to spend at least $5 trillion on AI infrastructure. Morgan Stanley talks about using significant risk transfers, a way to offload loan risk to other investors for data center exposure. Private capital firms, including eerily, are trying to take some of the risk. Morgan Stanley raised $30 billion for Meta in a single day. This author's take. Think about what's happening here. Banks are making huge loans to fund AI data centers, then immediately buying insurance against those same borrowers defaulting. Oracle's insurance costs are back at 2008 crisis levels. Microsoft has a AAA rating, but its insurance costs 50% more than Johnson & Johnson's, which has the same rating. When your lender makes you a loan and then immediately hedges your bet against paying it back, they're nervous about something. Morgan Stanley gave Meta $30 billion in one day and now looking for a way to move the risk off their books. The CME outage from a data center cooling failure scared Goldman enough to pause a $1.3 billion bond sale. These AI investments could take years to pay off if they ever do. Banks understand that risk, which is why they're creating ways to pass it on to other investors. So you can see that these credit fear gauges are starting to spike, particularly on Oracle. Even Microsoft is seeing it go up, though, as well. So we can see that there's a lot of different things moving around right now, right? There's a lot of different pieces to this puzzle. So is there an AI bubble? The Ramp Economic Lab just released data showing that the paid AI adoption actually declined in September 2025. Second spending declined this year. Tech companies have the highest AI adoption rate at 73%, but even that is plateauing according to their AI tracking index. Finance sits at 58% adoption, but here's the kicker. Retail is stuck at 34% and construction at 28%. AI isn't even breaking through the broader economy the way the hype would suggest that it is. A McKinsey survey confirmed that while almost all businesses are using some AI, very few are using it at any way that really moves the needle on their businesses. So most companies are still wait and see mode, and if you're counting on those companies to buy data center space, you might be waiting a long time. So here's another something that's kind of wild. AI companies are spending over $1 trillion, but primarily on each other. OpenAI commits billions to NVIDIA. NVIDIA invests in OpenAI. Microsoft invests into OpenAI. OpenAI pays Microsoft for cloud computing. Round and round we go. Goldman Sachs estimated that NVIDIA will make 15% of its sales next year from what critics are calling circular deals. OpenAI has made investment commitments to industry counterparts totaling $1.4 trillion. This creates an illusion of economic activity while really the money is just sloshing around between the same partners. When your lender gives you a loan and immediately looks for a way to move the risk off their books, like Morgan Stanley is doing after raising $30 billion from Meta in a single day, something should be signaling here. Now, here's what most people are missing. GPUs are no longer meaningfully improving in performance per cost and haven't been around for the last couple generations. We added 16-bit precision, then tensor cores, then high bandwidth memory, then 8 and 4-bit precision, and now we're essentially out of one-off features to add. According to Tim Detmers, a deep learning hardware expert, any further improvement leads to not straightforward gains, but to trade-offs. So the transformer architecture is already close to physically optimal. There's not much room left to squeeze out. We may be 1 or 2 years away from meaningfully scaling left because further improvements become physically infeasible. The entire AI investment thesis depends on continued exponential hardware gains, and the physics is saying that's cute, but it's probably not going to happen. So here's another number that should make you pause for just a minute. Hyperscalers are expected to spend $5 trillion on AI infrastructure. But here's what's different from investing in fiber or railroads or other bubbles that we're looking at. This hardware depreciates in just 2 to 3 years. See, fiber stays around for decades. So that creates a massive pressure to get these customers to spend on AI before the investment turns to zero. So OpenAI is expected to hit $20 billion in annual revenue, as they say this year, but analysts project that the loss could reach $140 billion over the next 2 to 3 years. Meanwhile, Google and Microsoft make around $30 billion in profit each quarter that can fund cheaper integrated businesses. So Anthropic is on track for a $9 billion in revenue, and that's impressive growth, but they're also not profitable yet. So when you're losing money on every single query and your competitive moat is shrinking, that $500 billion valuation that OpenAI is sitting on starts to look pretty aggressive. Now, there's a lot of other things that are going on here, but as always, if we can help your company to connect your systems, reach out to us, because here at Startup Hack, we love to help customers with their custom software needs. So check out startuphack.com. Now, Howard Marks, who called both the dot-com bubble and the 2008 financial crisis, just published a memo titled, "Is It a Bubble?" He points out that in every bubble he's witnessed, a new technology captures the imagination. Early participants enjoy huge gains, and FOMO drives the late crowd in without concerns for whether prices make sense. Now, the railroads were a bubble and they transformed America. The internet was a bubble that popped and it changed everything. Mark says it perfectly, quote, "Memories are short and prudence and natural risk aversion are no match for the dream of getting rich on a revolutionary technology," end quote. So we can acknowledge AI as real and transformative while also recognizing that the investment behavior around it might be irrational. Now, Thinking Machines Lab, founded by former OpenAI executive Mira Murati, raised $2 billion at a $10 billion valuation without releasing a single product or even telling investors what they're building. One investor described the pitch meeting, quote, "She was like, so we're doing an AI company with the best AI people, but we can't answer any questions," end quote. That was 2 months ago. Now they're reportedly raising at a $50 billion valuation, still no product. So when startups can't describe their product but raise billions, we're not in a normal market condition anymore. So this is where we're seeing some interesting times. So could we be in a level of irrationality? Absolutely. Could it also be that there's some useful technology? 100%. Here at Startup Hack, you can see behind me that we have a bunch of servers and stuff that we're doing, that we're building AI tools for customers in very specific ways. This is what I'm predicting is going to happen with the AI market. Out of it, we come a lot of great technology that can be used by developers who know how to leverage it. But you have to leverage it in a smart way, in a way that can actually help, and you have to make sure that it's safe. And that's what we're going to see as a niche down. We're not going to hit AGI. We're going to see a ton of niche technologies that get built using regular software practices. Now, protecting $10 million of Microsoft debt now costs $34,000 annually versus $20,000 in mid-October. So a 70% increase just in the last couple of months. Microsoft is AAA rated, the safest rating possible, but its insurance costs 50% more than Johnson & Johnson with the same rating. AI investments could take years to pay off if they ever do, and banks understand this risk. So by the same token, no one should stay completely out of risk, and missing one of the greatest technology steps forward could really hit you. So the answer isn't all in or all out. It's a moderate position applied with selectivity and prudence. That's the wisdom of someone who's been seeing this movie before. And in our case, we're using this great technology to build new software for companies that want to connect their systems and build AI into their processes. You do this in a real and comfortable and careful way, and there's some great technology that you can leverage. Now, I'm curious to hear what you guys think. Do you agree? Do you disagree? I love to have a great discussion, so make sure you leave a comment down below, and make sure you like and subscribe. Here at Startup Hack, we love to build custom software solutions for companies, so check out startuphack.com, and here's some great information about our services.
Hi, I'm Spencer, a fractional CTO. With over a decade of executive leadership and 25 years in software development, I've transformed technology teams and products for businesses just like yours. As your fractional CTO, you get the strategic guidance of a seasoned technology executive without the full-time commitment. Perfect for companies ready to leverage cutting-edge technology without expanding headcounts. My team at Startup Hack has already built advanced AI agents for small and medium businesses, automating complex workflows and delivering advanced ROI to human workflows. We specialize in creating custom software that connects your systems into a single coherent technology ecosystem. Our development approach focuses on tangible business outcomes. For one client, we developed AI-powered workflows that cut days off of human processes. For another company, by connecting multiple systems, we reduced processing time to increase their ROI by over 75%. We don't just write code, we architect solutions that scale. Whether you need cloud system architecture, data integration between legacy systems, or custom AI agents that automate your unique business processes, my team delivers results that exceed your expectations. Having led technology for a lot of companies and launched 7 successful brands of my own, I bring battle-tested expertise to your business challenges. Our specialty is turning technological complexity into business advantage. So if you're ready to harness the power of AI and custom software to drive your business forward, let's connect. Together, we'll build technology that doesn't just solve today's problems, it positions you for tomorrow's opportunities. Technology leadership, decades of experience, AI powered. Reach out today and we can help you. Check out startuphack.com/Spencer.